Myself, Dr. P. Archana from BCom CA department. Today we are going to see about few topics in corporate accounting. What is a company? A company is a voluntary association of persons formed for certain some common purpose. The capitals of these companies are divided into small divisible parts called shares. A company is a limited liability company. It is created by artificial person, created by law with perpetual succession and a common seal. So, in short, a company is an artificial person. It is a separate existence. Next, we are going to see salient features of a company. First feature of a company is it has a separate legal existence. That is, it is like a person, it is like a person. Next feature is it is with limited liability. Suppose if a person buys shares from a company, means he is called as a shareholder. If he buys 10 shares, for example, the share price is 100 rupees, means his cost is 1000. So if when a company is being winded up, his liability is limited to his value of shares. That is, he is liable to pay only 1000 rupees. His personal property will not be taken into account. So that is called as limited liability. Next feature is transfer of shares. In a company, shares are easily transferable. Next feature is it has a separate property. So the property of a company should be in the name of the company alone. Next feature is perpetual succession. The meaning of perpetual succession is that we have a quote, men may come and men may go, but I go on forever. For example, if a director or a shareholder transfer his shares, or director dies or becomes lunatic, the company will not come into an end. The company will be running successfully. Next is ownership is diverse from the management. Company is different and the management is different in case of ownership. Next, it should have a common seal. That is, it is the symbol of incorporation. A company without a seal is considered as an unincorporated company. Next, difference between a partnership firm and a company. In this slide we are going to see about difference between the partnership firm and a company. So on the basis of law, partnership firm should be registered under Indian Partnership Act, or partnership firm should be started under the conditions of Indian Partnership Act 1932, and company should be started under the Indian Companies Act 1956. Now it is 2013. Next, on the basis of number of members, there is a difference between partnership firm and company. In case of partnership firm, minimum 2 members should be there to start a partnership firm, and maximum 20 members are alone allowed to start a partnership firm. Next, in case of banking company, minimum 10 members should start the partnership firm. In case of a company, there are 2 types of company: public limited company and private limited company. In case of public company, minimum 7 members should be there to start a company, and there is no limit for a public limited company. But in case of private limited, minimum 2 members and maximum 50 members are allowed to start a private limited company. Next, in case of separate existence, a partnership firm does not have a separate existence, but in case of a company, it has a separate legal existence. Next, regarding liability, in case of partnership firm, the liability is unlimited. That is, if there are 2 partners, when company goes into loss, means the partner's personal property will also be taken into account for paying their liability amount. But in case of company, the liability is limited to the value of shares the shareholders hold. Next, in case of management, each partner is responsible for the management. But in case of company, board of directors alone responsible for the management, and shareholders does not involve in the management process. Next, in case of transfer of shares, in partnership firm, shares cannot be transferred. But in case of company, shares can be easily transferable. Next, in case of audit, there is a difference between partnership firm and a company. In case of audit, in partnership firm, audit is not at all necessary. But in case of company, it is compulsory to audit all the documents. Now, in case of maintenance of books, it is not compulsory to maintain books of accounts in case of partnership firm. But in case of company, it is very mandatory to maintain basic statutory books. Next, registration is not compulsory in case of partnership firm, but it is very compulsory in case of company. Partnership firm need not be registered, but company should be registered, then only it will come into a legal existence. If it is not registered, it will be considered as a illegal company. Next, in case of duration, when a company, in a partnership firm, when a partner becomes a lunatic, or when a partner dies, or if when a partner becomes insolvency, the firm comes to an end. But in case of company, it is independent. Directors may come, may go. That's what I quoted in the previous slide. Men may come, men may go, but I go on forever. So same way, in a company, it is independent regarding the duration. Next, we are going to see the kinds of companies. These are the types of companies. Companies are of many kinds based on the 4 types. One is formation, liability, ownership, and public investment. On the basis of formation, we have 3 types of company. One is chartered company, next is statutory company, other one is the registered company. In case of registered company, if a company is registered under Indian Companies Act 1956 or in Indian Companies Act 2013, it will be considered as a registered company. But in case of statutory company, it should be specially passed. It should be specially passed in the state legislature or in the central legislature. For example, LIC of India, Life Insurance Corporation of India, and Reserve Bank of India is an example for statutory company. In case of chartered company, in Great Britain, first chartered company was started. Example, the British East India Company. Now in India, we don't have this chartered companies. Next, based on the liability. Based on the liability, we have 3 types of companies. One is limited, guarantee, and unlimited companies. Unlimited companies that previously I explained. For example, in a partnership firm, if a company comes in, if a company is being winded up, the partner's own personal property is also liable for the payment of the liability. But in case of company, it is unlimited. That is, it is only limited to the value of shares they hold. So in India, we don't have unlimited companies, but in limited companies we have. That is, it should be registered under Indian Companies Act, and the limited liability means the amount of shares held alone. The liability is limited to the value of the shares held by the shareholders. In case of guarantee companies, the liability is limited, but it should be mentioned in the memorandum of association what amount is guaranteed or what amount should be guaranteed while winding up a company. Next type of company is based on the investments. We have 2 types of companies, private company and public company. In case of private companies, we have lot of restrictions on transfer of shares. The minimum numbers also differs in case of public company and private company. In case of private company, the minimum number should be 2 and maximum is eligible only 50 members. Then the word private limited should be compulsorily mentioned in the name of the company. In case of public companies, the company should be registered under Indian Companies Act 1956 or in 2013, and these companies get subscriptions from the public. For example, they will issue shares and debentures and get subscription from the public as a share capital amount, and they will run the company. Next, the members are not limited in case of public limited company. Next type of formation is ownership. Based on the ownership, we have 3 types of company. One is government company, the next is holding company, and the other one is the subsidiary company. Based on the government company, 51% of shares, at least in a company there will be 100% shares. In that, at least 51% of the shares should be held by the government. Maybe central government or state government, or both the central and state government may hold 51% of the shares. Then it will be called as a government company. Next is holding company. For example, there are company A and company B. Company B purchases company A means majority of the shares of A will be with company B. So B is called as holding company. That is, the purchasing company is called as the holding company. In the case, A is called as the subsidiary company because it is under the headship of B. So here B is the holding company and A is the subsidiary company. So this is purchased company, and holding company is the purchasing company.